morning, everyone. I'd like to thank Richard for that introduction and join him in welcoming all of you to this conference on the future of banking. The future of banking. Now, that's a pretty big topic, and we could spend weeks on it. I know we've just got a short period of time today, so we're all going to try to focus in on what we think is important and can be addressed in the time available. The future of banking receives a lot of coverage from many sources, ranging from regulators to media to analysts to investors. All those contributions have value, and some are brilliant. However, each of them should carry a disclaimer, and a Yogi Berra quote comes to mind. He said, "It's tough to make predictions, especially about the future." Well, with that disclaimer in mind, I thought I would organize my talk today first around where we are at now and how we got here. The future will then hopefully be easier to discuss. My perspective as a former CEO goes back a dozen years, the last 3 of which are as an industry observer rather than a participant. As such, my view would be that the dominant environmental features of the banking industry in Canada would be more basic than what is on that list that Richard showed earlier on. The list is very important, and it's probably where most of the work goes in, because that's where things are necessarily changing and where a lot of work has to go on to cope with that. But in the normal business of banking, the evolution of regulation, the interest rate cycle, the credit cycle, and the fourth one, which is very important, tail risk, are what I always thought ended up, especially when I look back, in dominating our activities. Indeed, the greatest influence of the last 10 years in banking was the financial crisis and the long-term impact on these 3 factors. As I think back to the financial crisis and everything that radiated from that, much of the discussion could take place through the lens of the 3 factors of the evolution of regulation, the interest rate cycle, and the credit cycle, and of course the fourth, tail risk. Therefore, I think it's reasonable when discussing the future of banking to put some focus on these areas. Let's start with regulation. My perception was always that regulation was approached somewhat differently in major jurisdictions. The differences were for historic reasons that mirrored the situation, culture, or tradition of each jurisdiction. The United States, compared to Canada, tended to be more rules-based and adversarial, with much greater political influence and judicial intervention, somewhat reflecting their historic and current legal and competitive system. Canada, on the other hand, tended to be more principles-based and consensus-oriented, with a mostly hands-off or light-touch orientation politically, as well as great independence of the regulator. Europe tended to be closer to the Canadian model, but was greatly influenced by the multi-jurisdictional issues. And in any event, most banking business went on in London, which was under FSA regulation. Any discussion of regulation would be dominated by the response to the financial crisis of 10 years ago. That response I see as having 2 main thrusts: a regulatory response and a political legislated response. The regulatory response was spearheaded by the Basel Committee and reached agreement on many changes to regulation. The political response, while present in most jurisdictions from a noise point of view, actually manifested most prominently from a legislative point of view in the United States. There were other legislated responses, such as in the UK, but America's effort with Dodd-Frank and other initiatives was the most prominent. As such, the area that has garnered the most attention recently has been the election of Donald Trump and the perception of great regulatory relief coming from a possible undoing of recent legislation. This narrative has seemed to spread across jurisdictions, and especially in the immediate post-election period, provided lift to banking stocks both here and in the United States. However, I would caution that any changes would be mainly relief from U.S.-oriented legislation. There's always a bit of a ricochet effect, but this is going to be very U.S.-centric. The majority of change that affected non-U.S. operations of Canadian banks would have been and will be as a result of agreements reached at the Basel Committee, historically. Statements from the Canadian regulator as lately as April would indicate that further advances on reforms are coming. I quote from Jeremy Rudin, Superintendent of OSFI, from April of 2017, open quote, "Canada has reached a significant juncture in the evolution of our approach to banking regulation. In the years following the financial crisis, agreements were reached by an international body, the Basel Committee on Banking Supervision. They have been by far the most important influence on our regulatory agenda in Canada. Now that influence is waning. Until recently, the committee has been working to complete the reform agenda, but those negotiations have stalled, and it is not clear when they will resume in earnest. Canada is preparing to move ahead on its own with a Canada-specific plan for improving our capital regime. If we conclude that the Basel process is unlikely to restart in the near future, OSFI will put that plan into action in a measured way, unquote. So it's important to remember that the regulatory process in Canada was not complete at the time of Donald Trump's election, and it is still not complete today. Far from it. So while a Republican administration might bode well for some relief from USA legislated restrictions that primarily affect operations there, we must not forget that further regulation is in the offing in Canada and that implementation of past regulation is still taking place. An example would be anti-terror and anti-money laundering regulation has been in place for a while, but implementation, enforcement, and sanction is ongoing and in some jurisdictions is increasing dramatically. Therefore, my bird's-eye view of our first factor, which was regulation, would be that any respite due to temporary political or other reasons would be an opportunity to catch our breath rather than lower our guard. Let's move on to number 2 of 3, which is interest rates. This was always an interesting item because although it has a huge impact on profitability, it's not an area that as a CEO you can easily operationalize around. There's a lot of people that think otherwise, but I will tell you that banks tend to seek to match interest rate risk on both sides of the balance sheet, hedging structural differentials. In other words, you can't safely do much about your view on interest rates on an opportunistic basis. You're mostly operating within risk-dictated structures. You could have a view, but that involves risk and capital, and so the reality is that banks tend to keep any view-taking on interest rates and their balance sheet to the margins. The biggest exception to this is the non-interest rate sensitive deposit book, where demand deposits in aggregate are given a model-based duration, and that permits an offsetting and very profitable interest rate structural assumption. In other words, demand deposits are paid short, but because of their stickiness in aggregate, are allowed to earn long. And so depending on the curve, one is left contemplating a future tailwind or a headwind. However, that contemplation affects your outlook far more than your activities. So how do we see this from a Canadian banking viewpoint today? Anticipation of higher rates in Canada is far more muted than the United States. For most Canadian banks, regardless of the USA operation, the largest part of their non-interest rate sensitive deposit books is in Canada. Canadian rates are much, much more subdued and are not expected to move as aggressively as US rates. And if they do, anything but a small rise in rates in Canada is a two-edged sword. There's a significant possibility, if rates rise too much, of giving back any benefit on the deposit book and more as a result of its impact on economic activity and the credit cycle. The problem with any benefit in Canada to deposit books from rising interest rates is that housing is very sensitive to interest rate moves, and any move upward could easily and probably create offsetting risks and issues in the consumer debt market and housing, the detriment of which would possibly exceed and maybe far exceed the benefit of a rate rise. And that brings us to the third topic, which is the credit cycle. The credit cycle. Discussion of the credit cycle in Canada has focused on the indebtedness of Canadians while downplaying that much of the debt has funded asset purchase, meaning housing. Well, let's glance at housing. When housing first started heating up early last decade, I recall there was much discussion about the levels of construction activity. There was much discussion and skepticism. I used to attend various industry meetings at the Bank of Canada, and I recall that a prominent chart in the decks we received from the bank had to do with household formation. The gist of the chart, and a point that the Bank of Canada made to us frequently, was that after the real estate bust of 1990, that household formation ran well ahead of construction activity. As a result, in the 1990s, demand was proceeding apace and supply was being created more slowly. At the low point, housing completions bottomed at around 140,000 a year, while household formation ran at about 160,000 a year. A large demand backlog for housing was building in the 1990s. That provided a sound basis for the upsurge post-2000 in construction activity, and some upward price adjustment permitting the market to clear. Housing completions moved up during the course of that decade to 200,000 per year, exceeding household formation and gradually filling the demand gap from the 90s. The emphasis that the Bank of Canada had put on household formation and its relationship to construction completions had been well worth noting, and that was a foundational concept for the long term. I believe it was important then, and it's important now as a guide to the longer-term health of the housing market. So you would say, well, that's 2 decades covered. Where are we at now? Well, I no longer attend Bank of Canada meetings, but I found an interesting report from last December from the Parliamentary Budget Office, which would be in many ways a 2017 version of those long-ago discussions I had at the Bank of Canada. The report has the exciting title, Housing Formation and Housing Stock, a Stock Flow Perspective, and it is dated December 13, 2016. Here's the parts that I find interesting. During the decade between 2002 and 2012, construction completions, as we discussed, stayed well ahead of household formation. This multi-year surge in construction completions filled the backlog from the 1990s, and then it overshot somewhat, causing the IMF to state in 2013 that supply was now in excess. So after 10 years of building rapidly post-2002, what was initially a pending shortage at the turn of the decade had become a surplus with overhang characteristics. Many people would remark that that was a blinding flash of the obvious, given the hubbub of building activity that had gone on. Well, here's something that's far less obvious. What the same PBO report also shows and goes on to say is that more recently, construction has again fallen behind household formation, but this time due to the impact of population increase as opposed to a dramatic drop in construction activity. Recently, in fact, household formations up to the latest reporting period in the report, which was from 2012 to 2015, have caught up and are now once again exceeding construction completions. This is an important factor in the long-term view of the health of the housing market from a supply-demand viewpoint. The PBO concludes that this excess of formations over constructions, which has gone on for that 3-year period, has soaked up part of that much publicized IMF excess. They do note, however, that there's still in an excess, albeit smaller, but we are closer to balance. Their forecast is for housing to be a net drag on the economy for the next 3 years in a small way, but then balance is restored. All that would point out that we have an expensive but somewhat rational market in housing in Canada, at least from a supply-demand viewpoint, and that tends to count over the long term. Remember, we're talking about long term as opposed to 1 year and any one city. Many have struggled to explain recent price volatility, but I do believe that long-term forces will dominate. So with that historic and up-to-date picture on the actual health of the housing market from a supply-demand viewpoint, let's now talk about the impact of a housing downturn, keeping that in consideration about the degree, the impact of it on the banks. The focus and noise periodically has been on the potential for an existential crisis at the banks because of their very large mortgage books that are held on their balance sheets. The narrative has been that housing prices collapse and defaults skyrocket, dishing out a major credit event to the Canadian financial system. So let's see just how credible that is. First, we have the backdrop of the fundamentals of the assets the Canadians are buying. But here are the other facts as to the bank-centric situation. First, underwriting standards are good and have been well monitored by regulators for an extended period of time. Canadian regulators and the banks have the benefit of both observer status and experience over the last decade of housing crashes around the world. Basel rules, local rules, internal bank rules, audit rules, stress test rules, and rules you haven't even heard of have all been updated and are being enforced with that in mind. Several markets have behaved in an extreme fashion in Canada over the last year or so, but we can presume that most underwriting standards would have been adjusted accordingly. Second and next, keep in mind that all mortgages above 80% loan to value are insured by the government in Canada, meaning CMHC. Third, many banks have insured additional parts of their mortgage portfolios. This is getting harder to do, but has left those banks in a position where that extra insurance runs for a number of years from here on out. Fourth, amortization has led the uninsured, seasoned part of the books to have a current loan to value averaging in some cases in the 50%, which is extremely conservative. So the size of the shock that would have to be delivered to make mortgage defaults move beyond an earnings suppressant to a balance sheet threatening credit event is enormous. Structurally, even a price decline shock the size of the one in the USA meltdown would not reach the levels in terms of its systemic threat in Canada. That does not mean it would be pleasant, and in fact, parts of the system would have extreme stress. However, the core of the system is actually well designed for exactly that stress. There may be a housing price decline, and it could come in a variety of sizes. However, the source of the grief being the mortgage books is not a high probability occurrence. So does that mean no worries, be happy? Far from it. What we need to look at is the ripple effect of slowing in construction activity that a downturn would trigger. When housing corrected in the 1990s, residential investment dropped from as a percentage of GDP from a peak of 7% to a trough of 4%. Construction employment fell from a high of around 6% to a little above 5%. Indeed, that same report from the PBO I mentioned earlier is predicting that residential investment will drop over the next few years from a little bit more than 7.7% to 6.5%. And it sees residential construction as a net drag on GDP over the next 3 years. This type of drag, if there isn't an offset in the economy by stronger growth in employment elsewhere, could affect unemployment. The statistics I just gave would seem to indicate that it would. Ground zero if unemployment rises due to a construction-led downturn would be the area of unsecured credit, not mortgages. Much smaller books, but still substantial in size. Recent growth in unsecured credit, including credit cards, has been proceeding apace, and credit losses have been historically good. And that's all good for now. There's nothing wrong with that credit experience, except the degree of the setback available, given a reversion to the mean, would be meaningful from an earnings impact viewpoint. In addition, we have become accustomed to a certain level of growth in these areas, and that would probably slow or stop a fair bit. So the future of banking as seen through the lenses of regulation, interest rates, and the credit cycle. How do we add all that up? First, in Canada, the regulators have said they have more to do. Furthermore, the implementation and enforcement of past regulation is ongoing, and in some areas picking up steam. I would most certainly not see regulation in Canada as easing. Interest rates, our second one, are a tricky file. The allure of extra profits on the deposit books are offset by the increased credit risk that might entail. Again, an unlikely tailwind when risk is considered. So far, our first two factors are neither help nor hindrance. The third is the story, though. The dominant feature of the credit cycle is the Canadian debt picture, and it is somewhat complicated. Canadians owe a lot of money but are able to service that debt, and well able from an interest service only viewpoint. They've been buying assets, and the assets have been appreciating. Housing is in transition, and with the possibility of a manageable hard landing, but manageable. It is unlikely to be at crisis proportions from an existential viewpoint, particularly as it relates to the secured books. The probability of retrenchment in the unsecured books as a result of fallout in employment markets is much higher. This would be a normal cyclical occurrence and would mainly slow earnings rather than damage the balance sheets. We do have downturns. All of this is within our normal cyclical expectations. If you heard these remarks as saying that I do not think of our three factors as a source of great optimism or great pessimism, then you have heard me well. The third factor, debt, is the tough one, and under most scenarios should work out. There will be cyclical pain, but we've seen that many times before. That's normal business for banks. What does worry me, though, is the fourth factor, tail risk. Let me explain. From a total debt viewpoint, Canadian balance sheets seem extreme. The number most quoted is debt to income, which is at an extreme level by historic and comparative standards. That's the 169% debt to income that's always thrown out in the papers. The good news is there are some moderating ratios out there. From a servicing capacity, Canadian balance sheets do seem more reasonable. From an obligated debt servicing viewpoint, meeting your income ability to meet total debt, we're at a high level, but we've been stable at that number for almost a decade. On an interest-only service ratio, we are actually at a record low, meaning good. That is consistent with the record low interest rates of the last few years. Let me say this again. The monthly interest payment requirements, interest only, for Canadians are at record low levels. That's the real reason people have been borrowing. It's been rational. The higher level of total obligated debt payments is mostly because you have to add on to the payments the amortization components, which actually builds value. So the ability to keep all this in balance is actually okay under current conditions. A lot of debt, interest rates low, we're well within our servicing capacity. Here's the tail risk. Canadians, however, appear to be extremely vulnerable to interest rate increases. Now, we've always known that we have a vulnerability to interest rate increases, but I think that the level of that vulnerability is far greater than it has been in the past. Rate rises would torpedo the low interest rate only ratio that we're dependent on for our muddle-through scenario, and it would torpedo it very quickly. The good news is that the Bank of Canada knows all this, and while this risk is significant, they're able to administer any rate rise with all of this in mind and be prudent. However, there's one big caveat, and therein lies the enormous tail risk. If inflation started to misbehave, or other jurisdictions raised rates aggressively, and the Bank of Canada's hand was forced in the direction of faster and higher rate increases, then the consequences would be serious. Out of respect for the current consensus and Yogi Berra, I'm not predicting this. However, as a tail risk, it exists, it's bigger than it has been in the past, and I actually think it's being underestimated significantly. It's worthy of note that the Bank of England appears to now be faced with exactly this dilemma. British economic growth is abating somewhat, but inflation is flirting with 3%. They're holding off on rate rises for now, hoping inflation abates. Let's hope that they're successful. It's worth noting that the central banks around the world since the financial crisis have been the prime movers in managing economies and softening landings. Their ability to do this lies in the peculiar post-financial crisis disappearance of inflation. Lower and lower interest rates have had little consequence when inflation was absent. If that changes, and even moderate inflation reappears, then all bets are off. Thank you, and I think I'll take a few questions now.
Okay, so we have two mics that are roaming the room. We have a first question over here from Janet Ecker.
Good morning. Thank you very much, Gerry, for a very interesting and provocative talk. Let's say the bank's hand does get forced, and they have to rise faster than they would normally. What's that going to look like?
Well, the first thing is that the first effect would be on you'd probably slow the housing market, and over time, we've said that the supply-demand characteristics are actually reasonable, looking out over 3 or 4 years, but construction activity would slow and formations would run ahead of construction activity, so you'd be building up a bit of a shortage over time. So this is something that would, on a cycle basis, fix itself. But while the cycle was playing out, construction activity would slow, employment would probably drop, and as a result of that, you would expect that you see some weakness and softness in your unsecured books. As I've said earlier on, in an effort to not be provocative, I think that's an earnings suppressant rather than a big deal for the balance sheets, and I do think it's within the normal cycle. That's for the Bank of Canada administers a rate rise. Now, I think you also tagged onto that if it got out of hand, it could get very serious. the amount of raise today to cause problems is much smaller than it used to be. You're embedding interest rates in the economy right now that are at, mortgages around 3%. We used to run at the beginning of the 90s, in the middle 90s, when you had the last downturn, you were running high single digit, and I think we touched double digit. But you were, I can remember people who had 9 5/8, 9%, 9 3/4. So a percentage point was a much smaller proportionate increase, and changed all those ratios much less. So if you go back to the housing crisis in 1990 and you look at it today, simple math would say that every proportionally any rate increase is something like 3 times the impact. And that's, I'm just using a very simple, it was 9% then, it's 3% now. So 1 point means more. So there isn't a lot of latitude to move beyond reasonably moderate increases. And the reason why I think the tail risk is much larger now due to that is because if you think it through, the amount of interest rate increase to manage the change in real rates, if inflation rises by, I don't know, a half point or a point, I don't know the number, you start to get into rate rises that are not going to be 10, 20 basis points. You start to get into a series of quarter-point rate rises. And today, if you think about that 3 times factor, each time you raise a quarter, it's like raising 3/4. And I think the damage could be fairly significant. So what's the way out of that? Just so that people don't think it's the sky is falling, but there is no day 2. The way out of that is that the impact of the slowing that would take place as a result of those rate rises and the fallout from it would tend to slow economic activity pretty quickly, particularly in areas that have been a source of inflation, and then you would expect inflation to moderate. So the Bank of Canada would keep all that in mind too. Like, they would move gradually, look for the impact, gradually look for the impact. And I think unless the inflation was something out, kind of North America-wide, that it could still be controlled. But you'd get into very large default scenarios outside of the mortgage books in the flow from the unemployment if you had large rate rises due to inflation.
Okay, so I have a number of questions here. So the widely held explanation for the resiliency of the Canadian banks during the financial crisis was good regulation, enlightened policymakers, and good luck. What's your view as a CEO during that time?
I would definitely say good regulation. I would say that the policymakers worked well with the banks, and I'm not really sure where the good luck component comes from, and if that has to do with the fact that the proportion of our business was not in activities that was at the epicenter of the problem. Well, we're in a different country, so that's not luck. That's where you do business. So I wouldn't disagree with that the regulation was extremely good and that the policymakers, I thought, worked very well with us. The part about the luck, if you're not at the epicenter of the crisis, I guess that's a lack of bad luck, but it doesn't mean you had good luck. So I would more agree than disagree with what you said.
Another question is, based on recent employee press, how will or should banking balance sales growth demands at the retail level with the equalizing sort of performance or management for shareholders?
Well, that's interesting because I've purposely kept this speech to a fairly macro level because that permits me to use my experience to comment with some high degree of validity, because everything that's here, I've been through, I worked with these cycles, and I have a pretty good idea of what is happening in terms of what I talked about today. That is a very industry-centric, current management-centric knowledge base that you're talking about there, and it's not one that I have at this time. So, you'd be asking me for opinions on something that would involve freelancing as a member of the public, and I'm here to speak in a more focused way.
Okay.
It was a good try, though.
And then another one over there. And Ivan over. Oh, I know.
Hi, Mike Lebson, Teachers. Wondering how much of it, well, two parts maybe, how much of the pie is already baked in the sense that rates probably can't go any lower, especially in the context of US rate rises and generally the state of the economy. How much of the incremental level of borrowing that you discussed in terms of the total outstanding debt, how much of that has contributed to the economy? How much, if that were to be held steady at 0.5%, let's say, in terms of base rates, if that were to remain steady, how much do you think the economy would slow just naturally from no longer falling rates? And then what is your take on the price of oil in that context as well, not just the what our neighbors to the south are doing?
Okay, so the thing I have to say in answer to that, first of all, a very good question, is that some of the most interesting meetings that I had from a learning things viewpoint was at the Bank of Canada, actually, and in some of the regulatory meetings, but at the Bank of Canada. And Tiff was there for a lot of those meetings. And there were some concepts that that the governor and the people working with him were continuously reinforcing, because we would walk in, and one of the things is in those kind of meetings where it's senior people from the banks and the Bank of Canada, you tend to there's parts of the session where it's wide open, you can voice your concerns and fears and all that. And it's kind of interesting that it was the part I talked about where they would roll out the household formation charts. That's probably a dozen years ago, at least 8 or 9. And so we'd go on a little bit. No, I'd say it's at least 10. And so we'd go on a bit about, I don't know, one of us had read the latest article about there's 100 cranes building condos in downtown Toronto, and there's a lot of activity going on. And because we hadn't seen a lot of activity, now there's a lot of activity. The immediate response was, can this go on? This is too much. Now, we were just at the beginning of something, and I have to say that the reason I went to this household formation discussion is because at the time, when those charts were rolled out, very specifically I was told, well, Gerry, it's nice of you to have an opinion and a concern and read the Globe and Mail, but by the way, here are some facts as to the fundamentals of supply and demand. And funny thing that 10 years later I finally got it, so I'm telling you about it here and saying that when it comes to housing that they were right, and I kind of like to look at that now and other facts. So one of the things that was also talked about as things went on, because those meetings went on over a number of years and I participated in them, and at the beginning of the cycle, when the household formation chart was showing a shortage of supply, that was something that was talked about a lot. But one of the things the bank did, and again, I think, I learned a lot from it, was as it got longer and longer in the tooth, it wasn't actually the concern about housing prices. That was a separate concern. But what was always brought up was the fact that we were getting really far down the road on domestic consumption, and that we were keeping our economy going by building a lot of houses, initially to fill a shortage, and then, it's kind of imbalanced. We're building a few extra, so not a terrible thing, but the economy was shifting, and the resources of the economy were going into domestic consumption, and it was going into industries that were non-export. And that was something that was discussed at the time, and the governor at the time actually, we all, we thought we were pretty sharp, so we would project this out and say, well, domestic consumption and emphasis on that seems to also parallel lack of improvement in productivity. Not saying it's causal, but it was happening at the same time. And it kind of looked like we'd get a certain point, it's fueled by debt, and you'd get to a point where there'd be a fair bit of resistance, okay? Which is what you're talking about now. And these conversations, as I say, went back a long time, and I told you about formations and the fact that I think that's still relevant and important to when you're trying to understand this housing market. But this discussion of domestic consumption versus export was what was brought up at that time in relation to, well, when we are getting too focused on housing from an economic balance viewpoint, what are the concerns? And the concern was exactly that we would not have the export engine available to us, and we'd hit that debt limit in terms of funding domestic consumption. So when we'd get very concerned about that, the governor would then turn around and say, and that's where the dollar adjusts. He wasn't calling a timing of it, but he says you won't have a lot of room, and you'll get your dollar will adjust, because it was at par 2 at the time. And the dollar adjustment should, over time, bring you back into balance. Interestingly enough, and I do think it's I don't want to discount the concerns that we have around our somewhat excessive housing market, but the soft landing for Canada is a transition from this aggressive focus on domestic consumption and debt to a more export-led economy. And there is some evidence, I mean, I haven't seen recent data, but there was some evidence that was starting to happen. It's a little harder to see in the macro numbers because of the oil downturn, but in the actual number of firms participating in the export markets and a bunch of more micro statistics, there is evidence that handoff could take place. I'm not, remember Yogi Berra, I don't want to get into the prediction business, but the answer to your question in all likelihood is that rates are at a half point, you said. The economy's kind of creaking along. If rates don't go down further or actually rise a bit, or you're postulating that, well, what happens? How do we move forward? Because housing will not add to things a lot. And the way we move forward is if we are able to transition and become more export-oriented. And that would be the fabled soft landing. And just, again, you talked about policymakers and all that. I mean, they haven't, I don't recall, it's probably been said in a speech that I didn't read, but I do believe that if you look at what has been taking place from a policymaking viewpoint, that's the plan. I don't know if it'll work, but it is a pretty good plan.
Hi, Gerry. Thanks so much for coming today. I'm Lois Tullo from GRI, and we're looking at global risks and trends, which very much correlates with your tail risk. And I wondered if you would look at it from even a further macro perspective on the global basis of, are there other sort of global risks and trends that you see tying into or correlated that maybe you're worried about that the room would be interested in?
Certainly. My biggest concern on global risk is one that, I mean, there's the obvious ones that, we got lots of stuff out there, right? And with Rambo in the White House, it's a little, it's kind of hard to, it's kind of hard to, and I'm not saying positive or negative or anything in terms of the current administration. I'm not in that business. I'm not a political pundit. But it is a pretty roller coasty type of experience. So that you can all watch CNN and think about it yourselves. But the area that I think that I would be thinking about is the area of cybersecurity. And the reason why is because from viewpoint of banking, we saw in the financial crisis the degree to which you can get contagion spreading through the system. And I think that from a viewpoint of cybersecurity, the degree we're vulnerable to a certain kind of risk and how that would take place. And it's, again, this is very taily because you've got, denial of service is very common. That type of attack is very common. The consequences are very uncomfortable, but they're by no means so far existential. And so, that's an area that, if it can be managed, it's not something that I would, be focused on from viewpoint of what you're talking about. If there's a denial of service attack that's successful on an important bank in Europe, it's not going to necessarily affect us here and flow through to North America. On the other hand, there's another type of risk and denial of service is discussed a lot and everybody talks about it, and stealing data is the next thing that is discussed. Again, not good. There's a type of risk involved, and it's very important. But again, they steal the data from some bank over in Ireland. Again, unless you have an account there, it doesn't really do much for you over here. The thing that could create a contagion effect from a viewpoint of fear and the shutting down of the system is if, and this is not easy to do, but it's not impossible. If a hacker, state, terrorist, whatever you want, got through and managed to corrupt the data in the core systems, that is something that, in other words, the actual balances that people have at a bank are tinkered with in some fashion. Hasn't happened so far, at least that I'm aware of. There's lots of protection around that. It's not something that I'm predicting, but your question was, what do I think is kind of the risk out there that could hit us from left field, and it would be, tremendous ripple effects. In terms of affecting the financial system, I think it's that kind of cyber threat where the actual data integrity becomes an issue. I don't think it's denial of service. I mean, if you shut everybody down for a month, that's a problem, but you can cope with denial of service. You can cope with it. It's not stealing data because it's bad, it's embarrassing for the institutions, but everybody's still operating the next day. Anything that corrupted the data, and these hackers are all amusing themselves with all kinds of interesting things they like to do. I have no idea why. And that is something that would be extremely mischievous in their view, but from the viewpoint of the financial system, could be something that triggered a tremendous domino effect. Again, extremely unlikely, but possible.
Another question, last question, right here. If I could get a mic just to their front, please.
Thank you very much. I want to ask the question that's the opposite of what Janet Ecker asked in terms of the interest rate. So I can't resist, because as a former CEO, you had a front seat view of the carnage around the world when Canada was relatively stable in many terms. Bill Wright and many other economists at OECD and elsewhere talked about the threat of deflation at the time. We saw that trillions of dollars were pumped in. Did you ever have that kind of a fear? And you talked about the virtue of a low interest rate, the virtue of a low inflation right now, which we kind of benefited from. But was that ever a concern? And related to that is the global financial crisis over?
What is it, which fear though? Because there was a whole bunch of them in there, and I could list the fears that affected me, but.
Well, yeah, that's right, it's a psychological question. The fear of deflation, did that ever factor into any of the things global deflation, not Canadian, at the time? Because a lot of people were talking about it because of all the money that was pumped in and things were just not moving up. Yeah.
I would say that if you, one of the and I would say I'd call it a dichotomy rather than, well, it could almost be a paradox, but one of the most interesting dichotomies as what the phenomena that you're talking about started to roll out is the ability of the commercial banks, of the banking system, to understand what the central bankers were saying and seeing. And the central bankers started to pursue quite aggressive programs on lowering rates and quantitative easing and all that kind of thing. And they were talking about deflationary forces. The commercial banks, by and large, I mean, as I said earlier on, view-taking is not something that you can really do effectively in a big way. But, we were virtually told that if we wanted to, on a very short term, take a view. And it was the most unusual thing I had experienced, because when I heard it, the governor of the Bank of Canada came out and said, we've moved to this level and we will not move it up for, and he gave the date, and it was 18 months or 2 years. So we have an asset and liability committee meeting, and we all get together, and we know we heard something. I mean, it's one of those things where something has just happened, I think. Now, it takes you about 20 minutes at the beginning of the meeting to kind of discuss that, because the fact that, wait a minute, he doesn't tell us that he's not going to move rates back up for 2 years ever. So why is he, or 18 months, whatever it was, so why is he telling us that? And we concluded that we were being told that for a number of reasons, confidence, et cetera, but it was also that if you were going to take a view, that now was the time to do it. And in retrospect, as I look back, continuously, generally, like the banking system tended to lag on that. Like we'd have been told, and we'd still go, well, you know, but rates can be raised at any time. And yeah, deflation, but you know, how likely is that? What is deflation? You know, like it took a while. Well, what is deflation? You know, the idea of zero interest rates, the idea of negative interest rates. If commercial bankers tell you, not central bankers, because they actually understood this a lot earlier, if they tell you that they saw negative rates coming and, you know, rates as low as they were, you know, I would put a very tight bell curve on that and say it's the tails that are telling the truth. It's not the bulk, if they're going to say they understood it, because there was a lot of resistance. And so I would say the number one thing is that we really, you know, didn't see the deflation to the degree that you're talking about. In Canada, you know, we didn't get it to the degree that you're talking about either, so it was easier to not see it. So I could get off the hook here. But in terms of the whole global picture, we were looking at everything, and it was mostly something that we didn't understand to the degree we could have, and the central bankers were actually pretty clear on it, that it was a force to be dealt with. Now, nobody took an opposite, because you don't take views, so we weren't at risk from that viewpoint, but there may have been some opportunities missed. The only thing I can tell you is that if we knew then, fully understood what the central bankers were telling us, we would have been even more afraid than we were. Anyway.